Welcome to the deep dive. Today, we're looking at something pretty huge, a massive economic U-turn, really. We've gone from decades of what seems like unstoppable hyperglobalization
Right.
to this new, much more nationalistic model. Our sources are calling it homeland economics.
That's the term, yeah. Captures the shift pretty well.
So our mission today is, well, pretty clear. We want to trace how we got here. Look at that whole history of global economic integration, trade, capital flows, jobs moving around. Why did it all sort of stall out? And then dig into this recent, really big pivot towards policies focused back on the home country.
And we need to look at both sides, right? The amazing promise that globalization seemed to offer.
Absolutely. And the real costs, some pretty painful costs, that sort of paved the way for where we are now.
Yeah.
Just to set the scene, I mean, you have to appreciate how fast things changed financially. Think about this. Daily currency trading in the big financial centers. A decade before 1995, it was around $190 billion.
Seems like a lot, but
But by 1995, it exploded, nearly $1.2 trillion every single day.
wow. That's staggering growth.
And look at private money flowing into emerging markets. It went from about $50 billion in 1990 to $336 billion just 6 years later.
So, I mean, those numbers just scream transformation, don't they? The whole global capital system was basically remade in, what, a generation?
Exactly. Fundamentally reshaped.
But, the crucial thing to understand here is that this wasn't just something that happened. It was a policy choice. It wasn't, inevitable.
Okay.
Historically, if you go back to the Bretton Woods system after World War II, international capital flows, they were tightly controlled, mostly because of fixed exchange rates.
So, if you were in Britain, you couldn't just easily buy U.S. stocks.
Exactly. Or bonds.
Yeah.
The thinking back then was that high capital mobility wasn't necessary, maybe even, a bit dangerous.
Interesting.
But markets, well, they tend to find ways around things. By the 60s, you had these workarounds popping up, like the euro markets. Then the fixed exchange rate system breaks down in the early 70s. And that's when richer countries really started taking down those capital controls.
Right.
Developing countries jumped on board later, late 80s, early 90s, and that kicked off the explosion you were just talking about.
Okay, let's unpack that a bit. If policymakers thought mobile capital was risky for decades, why the sudden shift? What were the huge theoretical benefits driving everyone, rich and poor countries alike, towards this new orthodoxy?
Well, the textbook vision, it was incredibly persuasive. The core idea was simple. Let capital move freely, and it will find the most efficient place for savings and investment globally.
Makes sense on paper.
Right. Poor countries need investment, but often lack savings.
Yeah.
Problem solved. Capital flows in. Savers anywhere in the world, they can look to the absolute best returns, diversify their risk. It was sold as just a pure win-win, more efficiency for everybody.
And the trade side of things was just as powerful, maybe even more visible. Our sources say world merchandise trade. I mean, get this. By the late 90s, it was about 16 times bigger than it was in 1950.
16 times.
While world output itself was only about 5.5 times bigger. So trade grew way, way faster than the overall economy.
Yeah, and that difference pushed the share of world exports in GDP from, 7% up to 15%? A huge jump.
Doubled.
And that massive growth in trade. It all hinges on that classic economic idea.
Yeah.
Comparative advantage.
The textbook example.
Exactly. The old East versus West, making computers and bicycles. Maybe the West is technically better at making, but that's absolute advantage.
Right.
But if the West is relatively much better at computers, and the East is, say, relatively less bad at bicycles, they both specialize. West makes computers, East makes bikes, they trade.
And crucially, the total world output of both things goes up.
Precisely. Everyone gets more stuff, theoretically.
But what's interesting there, and maybe gets lost today, is what economists originally saw as the real benefit of trade.
Yeah, that's a key point. Goes back to thinkers like James Mill, way back in 1821. He argued the main benefit isn't the exporting itself.
Which is what politicians always talk about.
Right. They talk about winning by selling stuff. But Mill said the real point is importing, earning the foreign currency so you can buy what other people make more cheaply or better than you can.
That's a much more nuanced view than we usually hear.
It is. But nuance often gets lost in politics, doesn't it?
So all these policies, fiscal discipline, opening up financial markets, pushing for exports, foreign investment, this whole package deal became known as the Washington Consensus, coined around 1989.
That's right. and heavily pushed by the big international institutions like the IMF and the World Bank. It was, for a while there, the undisputed economic playbook.
The gospel of the era.
Pretty much. But, and this is where it starts to get really interesting, despite all that momentum, all that theory, a truly global capital market, it didn't actually exist in the 1990s.
Hang on, how can you say that? You just told me capital flows were hitting $1 trillion a day.
I know, it sounds contradictory. But the evidence suggests the flows weren't behaving the way a single, unified global market would dictate.
Okay, how so?
Two main things. First, look at current account imbalances in rich countries. That basically measures if a country saves more than it invests, or vice versa.
Right.
In a truly global market, you'd expect massive flows out of rich countries with lots of savings toward poorer countries hungry for investment. But those imbalances, they only averaged about 2–3% of GDP in rich countries. Tiny.
Meaning the money wasn't really leaving home. Savings and investment stayed mostly domestic.
Largely, yes. Money mostly stayed put in London, New York, Tokyo. It wasn't flooding into the developing world on the scale the theory predicted.
Okay, that's one piece. What's the other?
Real interest rates. That's adjusted for inflation. If there was one single global capital market, the real interest rate should be roughly the same everywhere, right? Capital would flow until returns equalized.
Makes sense.
But they weren't the same. Real rates differed quite a bit between rich and poor countries. That tells you there wasn't one single world interest rate. The markets were connected, yes, integrated in many ways, but not truly unified into one single pool.
So the system was integrated but fragile and maybe introduced new dangers, especially for developing countries.
Absolutely. Huge dangers. Countries with smaller, less developed financial markets were suddenly exposed to these massive, volatile flows, and they could reverse direction incredibly quickly.
Leading to things like the Mexican peso crisis in '94.
Exactly. Or the Asian financial crisis that kicked off in Thailand in '97. Sudden capital flight just devastated those economies.
It exposed a real policy trap, didn't it?
It did. This idea called the impossible trinity. With mobile capital, governments basically had to choose. You couldn't have a fixed exchange rate and control your own monetary policy and have free capital movement. You could only pick two.
So if you tried to fix your currency, but your domestic policies weren't quite aligned.
Mobile capital would punish you fast. It led to huge instability. And, the initial advice from institutions like the IMF was often liberalize quickly, open up those capital accounts.
Which turned out to be problematic.
Deeply problematic in some cases. It took time for a more cautious view to emerge, recognizing that maybe some controls, particularly on short-term hot money inflows, might be sensible. Chile, for instance, had some success with things like holding period taxes to reduce vulnerability.
Okay, so developing countries were grappling with financial crises, but back in the rich world, in the US and Europe, there was a different kind of fallout brewing, right? Something affecting ordinary workers.
Yes, absolutely.
Yeah.
A quieter, slower burning issue, but ultimately just as consequential, maybe more so politically. The benefits of globalization were definitely not being shared equally.
How bad was it?
Well, one source mentioned that by 2006, the share of the economic pie going to workers in rich countries hit a 30-year low.
A 30-year low, wow.
And look at the U.S. after the 2001 recession. Typical American workers' real wages, they actually fell by 4% over the next few years.
Fell, even as the economy recovered.
Fell by 4%.
Yeah.
Meanwhile, labor productivity, how much stuff each worker produced, went up 15%.
Wait, productivity up 15%, wages down 4%. That's the core of the political problem right there, isn't it? How does that happen?
That massive gap is crucial. The mechanism really boils down to the global capital-labor ratio. Think about it. China, India, the former Soviet bloc, they all joined the global market economy,
Billions of people.
effectively doubling the world's available labor supply. From maybe 1.5 billion workers integrated into the market system to suddenly around 3 billion.
That's an incredible shift in sheer human numbers.
It is, and these new workers, well, often skilled, didn't bring much capital with them. So globally, you suddenly had way more labor relative to capital. That fundamentally shifted the balance of power against workers, especially in richer countries.
Putting downward pressure on wages.
Huge downward pressure. It wasn't just about factories moving overseas. It was about the bargaining power of the average worker across the board being weakened by this massive influx of global labor competition.
Okay, so we've got stalling efficiency gains, fragile capital markets causing crises, and rising inequality within rich countries. That sounds like a recipe for change.
Exactly. It set the stage for globalization's momentum to fade. This phase got dubbed Globalization. And importantly, this slowdown started before the recent big trade wars kicked off, around 2010 or so.
Why then? What were the specific brakes that got applied around 2010?
Our sources point to basically three practical things. First, the cost of moving physical goods just stopped falling. We'd already gotten the big wins from container ships and logistics. Those improvements plateaued,
The low-hanging fruit was gone.
pretty much. Second, managing those incredibly complex, sprawling multinational supply chains that stretched all over the globe. It started getting really costly and difficult. Companies began realizing the extra complexity maybe wasn't worth the tiny cost saving anymore.
Okay. Makes sense.
And third, the nature of economic activity itself was shifting. More and more value came from services, healthcare, software, entertainment, finance. And services are just inherently harder to trade across borders than, say, a television set.
Right. You can't easily ship a haircut.
Yeah, exactly. So those three things kind of put the brakes on trade growth.
And this slowdown happened even as we entered what some call the third wave of globalization, the one driven by information technology.
Yeah, the second unbundling, as it's sometimes called. Since the 90s, IT made it super cheap to move ideas and information across borders. That's what fueled those intricate global supply chains, like Apple designing iPhones in California but assembling them in China.
Which makes the current situation, this geopolitical tension, particularly tricky. One source had a great line, putting tariffs on these deeply integrated supply chains now is like,
Ooh, erecting a wall in the middle of a factory.
yeah, it's a powerful
Image, because that's how integrated things became.
And yet, that's kind of what's happening. The world seems to be polarizing, splitting up.
It really does. Driven by what? Four big recent shocks. You had the 2020 recession, revealing just how fragile those supply chains were.
If we felt that.
Then there's the intense U.S.-China rivalry, Russia weaponizing energy exports. And now, this looming uncertainty about generative AI and what it means for knowledge work globally.
And in that context, dealing with autocratic countries, which now account for over 30% of global GDP, becomes really politically fraught for Western democracies.
Right. Maintaining deep economic ties with strategic rivals is suddenly seen as way too risky.
Which brings us finally to this radical alternative. Homeland economics. This seems to be the new buzzword.
It is, and it's explicit now. People like Jake Sullivan, the U.S. National Security Advisor, are openly talking about merging national security goals with economic policy.
So the focus shifts completely away from just efficiency and low prices.
Towards reducing risk, geopolitical risk, supply chain risk, dependency on potential adversaries, security over pure economics.
How are governments actually doing this? What are the tools of homeland economics?
Well, the first big one is subsidies and industrial policy. We're seeing an explosion of this. Governments are intervening like crazy, over 1,500 new industrial policy measures globally in just 2021 and 2022.
Wow. Examples like the GPS Act in the U.S., the Inflation Reduction Act.
Exactly. Those aren't just environmental or tech policies. They are tools designed to force strategic industries, semiconductors, green tech back on shore, or at least to friendly shores, reshoring, friendshoring, whatever it takes, almost regardless of the immediate cost.
And the EU is doing similar things.
Yeah, the EU's got its Green Deal industrial plan trying to keep pace. It's becoming a global subsidy race, in a way.
So paying companies to build at home. What else? Are they using sticks as well as carrots?
So definitely. The second tool is trade restrictions. But not just old-school tariffs. We're talking sanctions, screening foreign investments much more aggressively. Governments are using these kinds of punitive measures more than 4 times as often as they did back in the 90s globalization heyday.
And the global referee, the WTO.
Effectively sidelined. The U.S. has blocked appointments to its dispute settlement body, which basically means the WTO can't enforce the rules anymore. The system that underpinned globalization is being actively dismantled.
Leading to more regional blocks, like Asia trading more within Asia?
Precisely. The vacuum is being filled by regional arrangements, often driven by geopolitical alignment rather than pure economics.
Okay, so let's try and wrap this up for you, the listener. The big takeaway here is this major shift towards homeland economics. It's being sold as a way to make the world safer, fairer, and greener.
That's the promise, yeah. Replacing the perceived chaos of the global market with targeted government action.
But the experts we're looking at, they're pretty worried. They fear it might actually create the opposite outcome.
The potential economic costs are stark. Some estimates suggest that if the world really does fragment into rigid blocks, global output could fall by anywhere from 2% to over 5%.
5%. That's
Yeah.
like the whole world choosing to do Brexit, economically speaking.
It's a massive hit. And it translates to higher costs, less choice for consumers in rich countries, and maybe the most worrying part, poorer countries losing that crucial pathway of trading their way to prosperity. That latter might just get pulled up.
We're already seeing signs of this fragmentation, like prices for the same goods differing more across countries.
Yeah, that's a key indicator economists watch. Rising variation in relative prices suggests the world economy is sort of atomizing, breaking apart.
Here's the political puzzle, isn't it? If the costs are lower overall growth, maybe slightly higher prices, but the benefits are things politicians can point to. Look, we saved these jobs. Look, a new factory. Aren't voters likely to accept that trade-off?
That is the fundamental political trap.
Ah,
History is full of examples showing that turning inward autarky is economically damaging.
yeah.
You mentioned the U.S. embargo back in 1808 cost them 8% of GNP.
Huge cost.
But politicians keep going down this road. Why? Because the benefits of homeland economics, like that new factory or a subsidy announcement, are immediate, visible, politically popular. You can cut a ribbon.
While the costs slightly lower income growth for everyone, reduced efficiency are diffuse, spread out. Hard to pin on any one policy or politician.
Exactly. Nobody gets blamed for GDP being 0.1% lower than it might have been.
Which leaves us with a final, maybe unsettling thought to chew on. This push for homeland economics, it's clearly expensive. And it seems unlikely to quickly solve the deep problems like inequality or get rid of reliance on, say, China anytime soon.
Probably not in the near term now.
So what happens when the political buzz wears off, when people realize that this new model is costly and maybe the only real economic penalty is just slightly lower measured incomes? Will governments feel forced to double down, to make it work with even more state control, more aggressive industrial policy, maybe even bordering on something less free?
That's the worrying question, isn't it? Where does this path ultimately lead if the initial promises don't quite pan out? Something to definitely think about.
Indeed. Thank you for joining us for the deep dive.